Hey, what's up guys? Alan here with eatsleeptrade.net. I want to be bringing you guys a quick lesson video on what is swing trading and specifically what swing trading is with technical analysis and using technical analysis. A lot of new traders come into the market and they are unsure on the type of trading strategy or style that they should use as far as whether they should be focusing on day trading, swing trading, or more of a long-term investing. I found most of my personal success using a midterm to short-term swing trading strategy, and that is what we're going to be talking about today, what swing trading is, and specifically with technical analysis. If you guys enjoy these videos, please do me a favor, hit the like button down below, and don't forget to subscribe for our future lesson videos. So let's start off with the simple question, what is swing trading? The basic idea behind swing trading is a style of trading that attempts to profit from targeting short-term swings in the market. So what does that mean? So if you take a look at the little image here to the right, you can see there's some annotations on this chart with the terms swing high, and you can see a couple, 3 or 4 of those, and the term swing low, and you could see a few of those. Now what these swings refer to is exactly what they say. These are the high points and the low points of these swings. So a move from a swing high to a swing low is a swing, and swing trading is attempting to profit from these short-term swings from either a swing high to a swing low or a swing low to a swing high, whether you be going long or short. Now an average hold time for a swing trade is essentially anything over 1 day. Day trading, you're going to buy a stock and sell a stock on the same day, and swing trading, you're going to be holding that stock overnight, or possibly for 5 days, or maybe even up to 4 weeks. There's really no set time frame or hold time that you have to hold a swing trade. It's generally just more than a single day, and usually less than something that would be considered a long-term investment. So you're not looking to hold a swing trade for a year or 5 years. Now there's a couple type of trades that we focus on as swing traders, and those are going to be number 1, chart patterns, number 2, breakouts, breakdowns, and number 3 is going to be pullbacks. So let's go ahead and take a look at a couple examples of these 3 types of setups. So let's take a look at the daily chart here for the stock symbol of OCLR. If you guys are unfamiliar with what you're looking at right here as far as these candlesticks and this chart goes, we have many other lesson videos for you guys that you can check out to get a basic understanding of what Japanese candlesticks and stock charts are. But the basic idea, or one type of pattern that we like to trade as swing traders, is going to be a wedge breakout. And if you go over to our website, eatsleeptrade.net, there you can see a very good description of many different types of pattern breakouts. And if you look right here, the first one we're going to be looking at is a wedge breakout. And this was an example that happened back on MDXG, and you can see you have a set of higher lows, a set of lower highs, and a tight range consolidation. So the range is getting tighter as we get closer to the edge of this wedge, and then you get that breakout with good volume and a decent push. So another example of that is right here on OCLR, and you could see where it's putting in the set of higher lows. You can see where it topped out here and begin to put in a set of lower highs. The range got tighter and tighter as it consolidated until it was able to break out to the top side of that wedge, and you could see it had good relative volume on the bottom of this chart, and the trend continued after following out of that chart pattern. Another one that we just discussed is breakouts or breakdowns, and one example of a breakout that we just recently traded here on OCLR is going to be right here on this little doji that you see, and the resistance area prior to that breakout was right up here, which was around 750. So that morning the stock gapped up over our prior resistance, traded decent volume that day, and that was a trigger for us to get long. And as you can see, for the next following days, the stock made a nice run up into the 870s before pulling back. So there's a good example of a breakout or resistance breakout, and another type of pattern or strategy that we look to capitalize on. Now let's go ahead and take a look at AMD, as this one has been on quite the uptrend for quite some time now. And this is going to give you an example of what a pullback a buy is. So you have a stock that's trending up for several months, and through these several months you get all these little breakouts where the stock makes new highs. As you can see, this breakout came up to about 550, and after hitting that 550 mark you could see the consolidation or the pullback that occurred as the stock cooled off from making that prior high. And this little green circle right here represents an area at which we bought the stock when it was coming out of this pullback. And you could see that after it came out of that pullback, the stock then made a nice breakout and then put in a new high. Then essentially you would wait for the next pullback, you would buy again and put in a new high. And you could essentially continue doing this on stocks that are putting in uptrends that you can identify through technical analysis to provide yourself with many, many trading opportunities. So let's take a look at what swing traders focus on. And swing traders typically tend to focus on price action, volume, their risk, trends, support, resistance, and all of these things combined together basically create technical analysis. Now, there's a lot of back and forth on whether or not technical analysis works over fundamental analysis. In my opinion, technical analysis absolutely does work because all known information about a stock is represented in its price. There is no secret stuff about the stocks out there. All information about these companies are in the public, and anyone and everyone can take a look at them. So stocks that tend to trend up are going to be companies who have good fundamentals, strong catalysts, and a good business model. So you don't need to do weeks and weeks and weeks of fundamental value research on a stock to see that it's a strong stock. All you need to see is that the stock is trending in an upward direction, and every time the stock pulls back or dips, there are people stepping in to buy up the supply of that stock and creating a higher demand. These are going to point out strong companies, strong stocks, and opportunities for swing traders to capitalize on. Things that we want to ignore as a swing trader, especially when using technical analysis. So one of the first things is noise. That could be noise from social media, that could be noise from any type of news or TV stations that you watch. That could be any type of noise from a market analyst. Market analysts are probably wrong more times than anyone is, so they're not going to give you the right direction. Secondly, you want to ignore any type of hype. If you hear people cheerleading a stock, if you hear people saying, this is the next big thing, if you hear people telling you that if you don't buy now, it's going to leave you behind and this stock is going to the moon, any type of those things are going to be called or considered hype, and you want to ignore those. If you get caught up in the emotional hype of trading, you are destined to lose all of your money. And as a beginner trader, it's hard to see that, but after you gain some knowledge and experience under your belt, you will easily be able to identify when people are hyping up a stock. And another thing that's always good to ignore is going to be a story. You'd be surprised at how many people will make up a story about a low dollar traded stock to try to get its price to be pumped. There's people that'll take it as far as creating fake websites to show some type of story for a stock that they're trying to hype up and get you to believe a story and buy into their stock. So don't believe any stories that you read about the stocks or that people are trying to convince you of. Ignore that stuff. It falls into the hype and falls into the noise category. And last but not least, but that is the PR, personal relations, things like that, and the pumps. This is probably what kills most traders, and that is the pump and dump. And a pump and dump happens from, or can happen from, many different standpoints. First, you could have a guru that you follow who sends out stock alerts, and that is the most common way to do pump and dumps, and that is to have, again, a low float stock, send it out to thousands of people on your email list as a buy alert while you've already bought the stock prior to sending out that alert, and then you sell into everybody who gets the alert and starts buying the stock, only to later tell everybody, oh, it wasn't that good, so I decided to sell. Now, that is probably the most common form of a pump, but definitely not the only type of pump. Companies do pumps all the time. That is the whole idea behind trading on the stock market, is so companies can raise money to fund their business or to expand their business or to do research or a number of things that they want to do. That's why they're trading publicly. So these companies absolutely will release PRs and pump up the share price of their stock. So one, insiders can buy low and sell high, so insiders can make money, and two, so they can dilute the stocks and print more shares and increase the float and raise capital by selling shares to people that are buying, not realizing or understanding that they're buying into a diluted stock. And one of the last things we'll touch base on, and is a huge factor for swing traders, and that is the risk. And while you're holding stocks overnight, so your risk is higher than somebody who's day trading. You're at risk to having some type of news or bad catalyst happen overnight while the markets are closed and having a big reaction after hours, or pre-market before the markets open, or right into the open where a stock can be very volatile. So you do put yourself at a higher risk than, per se, a day trader, but you're also putting yourself at a much lower risk than a long-term investor, where they're going to leave their money in a stock for 6 months more, a year, 2 years, 3 years, and within that time frame, there's so many more things that can happen. And a perfect example on that would be Chipotle. That has been a huge stock that everybody's been buying. It's been doing really well. It's a blue chip stock. It's a company that is very fundamentally sound. And then they had that food poisoning breakout, and the stock completely crashed. And every person who's invested in it is losing money and upside down within the last 4 or 5 years. So when it comes to short-term swing trading, you have a lot less risk in losing all your money, especially in the time that you've put in. If you've put 3 years to make $50,000 and then you lose $50,000 in 1 month, it's not a very positive feeling. It does not create a very positive feeling for yourself. So there's a couple things that swing traders focus on. So let's go ahead and take a look at the next slide here. So let's jump into the required knowledge that you need before you begin swing trading. There's no diving when it comes to trading in the stock market, and that comes with whether you're going to be a day trader, a swing trader, or an investor. You're not just going to grab a handful of money, throw it into the market full on deep, and expect to be successful, make money, and not lose everything that you have. There are so many things that you need to learn before you begin to trade into the market, so you can protect your capital and protect yourself and your livelihood. So let's talk about some of the required knowledge you need before you begin swing trading. First, you're going to need a solid risk management plan, and this is the number one rule in trading, is you need to have a risk management plan. Again, you need to know what you're willing to risk, you need to know what you're willing to lose, and you need to know what you're going to win if you're correct. A max loss per trade is a must-have, and a common one for me is never losing 2% of my maximum or of my max capital, my total capital. So if I had a $5,000 trading account, then I don't want to risk more than 2% of that $5,000 or $100 per trade. That is of the essence and important. Starting out trading, and probably even as you become successful as trading, you're going to have more losing trades than your winning trades. But the way to be successful with trading is having a proper risk versus reward. Now, what this does is allows you to set a solid risk on your trade plan and prevent you from losing more than you would on a winning trade. So if you have a risk versus reward ratio of all the time of risking $1 for a $3 reward, or a 1 to 3 risk reward, then you're setting yourself up for success, even if you can only win one winning trade and you have 2 losing trades. You should still potentially make money and be profitable because you used a proper risk versus reward and a max loss per trade, preventing extreme drawdowns on your total capital. Now, the third most important thing about that risk management plan is having the discipline to follow that risk plan. And this is where most traders struggle and fail, is they have a good idea, they know how much they should risk, they pick a good entry, they know where their stops are, they know where their reward is, they have a good risk versus reward, but when the time comes to trading, they don't follow their risk plan. One of the most important things to learn as a trader is that it's okay to lose and be wrong. It's not okay to stay wrong. Do not let losses grow out of control. The second thing you need for swing trading is a basic understanding of technical analysis. Technical analysis is the whole idea behind short-term swing trading and capitalizing on those market swings. And a basic understanding of technical analysis comes with an understanding of candlesticks, trends, whether that's an uptrend or downtrend, and being able to identify these trends and identifying when these trends change. Identifying support and resistance, or supply and demand, and understanding when these areas are broken. Another thing is understanding chart patterns, being able to identify chart patterns through the stocks that you scan or screen to create a watch list for yourself. And last but not least, but indicators, including indicators as simple as volume and simple moving averages that can guide you in a general direction of the current market. Third, you need to have a strategy for creating a strong watch list. This includes how to scan for stocks. There's many programs out there that you can use for scanning, and there's a lot of different options. Options that are free, options that cost money, some that are better than others, some that'll suit you depending on whether you're going to be day trading, some that'll suit you if you're just going to be doing swing trading, and others that you might want if you're doing a long-term type investing. But you need to have some type of scanning tool to set parameters on the stocks you're trying to trade and reduce the number of stocks that you're looking at once. You need to be able to take these stocks that you find through your scans and organize them into a watch list that can benefit you and allow you to identify the strongest players in the market at that time, whether that be focusing on strong sectors or just on strong uptrending stocks. But without a strong watch list and an organized watch list, it's very difficult to find strong plays in the market every single day. So creating a strong watch list is definitely key and something that you need to have knowledge in doing prior to you entering into the markets. And last but not least, you need the confidence to pull the trigger. You need knowledge in the market and general swing trading so you have the confidence to hit the buy button and you're prepared with a proper trading plan and a set risk to protect yourself and your capital. When first trading the markets, you should never attempt to jump in with real money. There are many available websites where you can practice trading with virtual money for free. Practice will never give you the same experience or emotions as real money. It is a great place to start. If you are unable to create trading success through a practice account, it is also unlikely that you'll be able to create success using your own real money. And lastly, traders need to have the right expectations with the market. If you're showing up to the market with a $1,200 account and you're expecting to win $500 a day profit, you might want to step back and reconsider your expectations. The expectations of the market should be a slow, steady, and consistent grind to new account highs, and should never be to hit a home run or find that huge play that's going to run and break out for 1,000%. Slow and steady wins the race. Alright guys, and that is going to wrap it up for this video. Thanks for watching What is Swing Trading with Technical Analysis. I hope you guys were able to take some value from this video and gain a better understanding of what swing trading is if you are new to the stock market and trading in general. If you haven't already, please hit the like button down below, and don't forget to leave me a comment letting me know what you guys thought about this video and maybe if you have any suggestions on how I can improve the content. Also, down in the comments I will leave links to further video lessons on each of the articles we discussed in this video, from risk management to identifying trends, support and resistance, Japanese candlesticks, technical analysis, and much more. Thank you guys for watching, and we'll see you in the next video.